Ladies and gentlemen of the board, welcome to the Evnono performance review. So looking at our business model, we use the memo solver model. It made a good idea about employees working for stock instead of wages. We get 15% to our employees, the winning team get a little bit more, so maybe there's something to think about there. Quarterly model, no stock sold to investors, which was what we followed throughout. Multi-period modelling, we altered it each quarter with finances in mind. As you can see, we changed our strategy from market share maximisation to cost cutting, and then obviously quarter model had a few minor cash flow limitations, but overall we had a well-calibrated and valid business model. So I'm going to take you through the annual analysis and key highlights for year 1 and year 2. So looking at year 1, as you can see, we started late on day 4. So our rationale behind this, we were cautious to kind of begin the game while we were trying to interpret the Excel models. As a result, we may have missed out on a slice of potential demand. We calculated around about 40,000. Okay, so moving on to annual expenditure of PPE, we reached 85,000 on PPE and an average of 21,500 per quarter on both marketing and R&D. So what we looked to do was use progressive investments in both R&D and marketing coupled with PPE to make sure there was a right balance so that we had a high average utilisation. I think in the first year it was 94.5 and second year 95.8. So our utilisation is high, which means that we're actually meeting demand perfectly with our capacity, which is what we try to do for cost purposes. Okay, so as you can see here, an average of 6,000 increase per quarter on both marketing and R&D. Okay, so this was a method of stimulating demand because we worked out in the equation that marketing, R&D and shares for employees were the key drivers of demand. Okay, so what this helped us to do was reach a 23.5% market share by the end of year 1, which put us in a strong position for year 2. Looking at the burn rate, it was altered 61 times over the course of the first year, between 0.3 to 1. So obviously a lot of this altering of burn rate was us trying to monitor low costs by trying to keep demand level with actual capacity. And what this actually led to was high utilisation, so low cost, but one of the issues that resulted was occasionally we had excess demand where we weren't actually able to meet it. Okay, moving on to year 2. So 15,000 invested into PPE, a lot less than last year, 100,000 total. What we looked to do this year was we hit sort of a peak of 30%, and so we didn't really need more capacity than that because 100,000 actually balanced quite level with 30%. So, okay, this led to a lower cost of running facilities again. Marketing and R&D, this is what we tried to do was a cost-cutting strategy, but this was in the 5th quarter, which we felt was too early. So we boosted marketing and R&D up to 35,000 and then dropped them suddenly. And what we did that for was to try and boost earnings by lowering our cost base. But the issue was we implemented it too early in quarter 5, left us with a lot of cash in quarter 6, but actually we resulted in a penalty by reducing marketing and then increasing again. And what this happened was we actually had a huge loss in market share. Okay, so what we tried to do to offset that was we gave some shares to employees. And we gave that to offset the reduction, again, from the loss in market share. However, it still fell from 30% all the way down to 17% on 728. So we should have implemented that later, the cost-cutting strategy. Okay, so marketing then, we realised we'd had a bad cost-cutting strategy. We boosted it up to 38,000 in the 7th quarter and then dropped it to 0. And what we did there was we actually tried to attempt to claw back some lost market share in order to boost earnings. And although we gained some back, we didn't gain enough back, and our revenue was lower in the 7th quarter than in the 8th quarter than in the 7th quarter. Isberg said that a comprehensive financial statement analysis would provide insights into a firm's performance. So Beth's going to run you through the 3 financial statements and analyse them for us.
The first statement we need to look at is the balance sheet, and a point to discuss is the expansion of non-current assets. In the first year, these rose from 17,205 to 76,831, an increase of 346%. However, in the second year, they've ceased to expand and began to decrease slightly from 87,318 to 72,318, a decrease of 17.17%. The next statement that we need to look at is the cash flow. So here we need to look at the change in cash balance. Between the start of the first year and the beginning of the second, cash balance rose very slightly from 9,581 to 9,774. This could be due to the fact that we were following the quarterly model and so didn't raise any money through sales to investors, and so we're waiting for cash receivables to become liquid. However, in the second year, we saw a substantial increase of from 17,384 to 392,166, which is an increase of 2,155%, which means that we don't have to worry about whether or not there's enough cash available to purchase more equipment. The next statement that we need to look at is the income statement. So we looked at the increase in operating profit, which over the 2 years was 500.5%. This increase could suggest availability of resources to hire more staff and increase productivity. We also looked at how profit margins fell. So in the third and fourth quarter, they were fairly low due to the high cost base, as seen here in operations, marketing, research and development. However, in quarter 8, we had the highest profit margin of 54% due to cost base falling to zero, particularly in research and development. In order to analyse these, we then looked at some ratios. So our operating profit margins over the 2 years increased highly in year 2, so to 52.54%. So that gives us a return of about 52 pence per pound compared with 17 pence per pound, which means that there's lots of cash available to buy more plant and equipment in order to increase productivity. As you can see, our average inventory turnover was negative, so we may need to invest money in that plant and equipment from the profit in order to improve productivity and save customers long waiting times. The asset test ratio shows a healthy increase to 89.3 times in the second year, so our costs are easily covered, so we should have no problem in investing that money. And then our return on capital employed is fairly similar over the 2 years, was extremely healthy, so we should be looking to maintain or even improve on that.
Okay, now we're going to look at how we would improve Exnovo's performance if we were to run the business game again. So the first thing we'd do, we'd increase R&D instead of marketing. And that's because R&D is based on the total amount invested, whereas marketing is based on a monthly rate. Okay, what we would have done is we would have cost cut R&D and marketing on day 637, which is, just before the last quarter, because we cost cut too early in quarter 5, and this led to a low market share coming into the last quarter. Okay. We'd make sure there was never excess demand, so we had issues from day 1 to 546. Although there were small issues of excess demand, we still kind of gave away some demand to competitors. We'd start the game on day 1 and not 4. We felt we missed out on a bit of demand while we were trying to interpret the models. We'd never lower and then increase marketing or R&D because that resulted in a $0.05 penalty per rate. What we'd do is we'd invest in R&D and employees to gain market share because we felt that maybe we didn't invest enough in employees to gain sort of market share. We invested too much. We focused too much on R&D and marketing throughout. We invest more in PPE and not cost cut in quarters 5 and 7.
Okay, so next we've got the team reflection, and these are just a list of points that we thought that we could improve on. So we thought we could provide an increased frequency of team meetings, so that would help to reduce the amount of conflicting actions that occurred. We thought we'd more clearly define our roles, so each member of the team would kind of know what they're doing more, and that would avoid repetition. We would also set quantifiable goals. So for example, we would say by the end of the next quarter we want to increase our market share by say 5%. We would also better delegate tasks, and our time management we thought was important, and we thought that this would also reduce the amount of rash decisions that were made.
So you have the limitations of the business as a whole. You've got unrealistic profits due to no tax or inflation. Generally, you have external growth in a business where this is only internal, so there's no merger acquisitions or borrowed finance. Little interaction between companies themselves, which is obviously a problem, and there's a globalised market, so you do have different market conditions. That's just one.
The DuPont ratio is the excellent way to get a quick snapshot view of the overall performance of the firm. Return on equity also has been accepted by shareholders as one of the most important financial analysis. If you can go to the end of your PowerPoint presentation printout, you'll see the special financial spreadsheet designed for your convenience to understand the financial performance by Exnovo. At the top you can see the raw data. In the middle section you can see the actual DuPont analysis with return on equity right at the bottom of the section. As you can see, in the first 3 quarters we had a very strong performance, but unfortunately throughout the second year we had strong fluctuations within results, with quarter 6 providing the strongest ones. You can also see additional ratios right at the bottom of the spreadsheet.